My name is Lawrence J. Danny. I'm a CPA and former IRS agent, and the title of this video is IRS Audit Part 1 Income Probe. What I'm going to talk to you about today is how the IRS audits income. The first way they audit income is they compare what their records show to your tax return to see that you reported all of your income. So you may have income from interest, dividends, wages, 1099s from customers, rents if you're a landlord, distributions from retirement accounts, Social Security, or stock sales. So the IRS is going to compare this to your tax return to see if you reported it all. The second way they're going to audit income, and by the way, the income probe is a mandatory audit step, so they're unlikely to miss it. It's a big part of the audit. The second way they're going to audit income is they're going to do what's called a bank deposit analysis, and they're going to add up all your deposits from all your bank accounts and compare that total to the tax return. So it's incumbent upon you to keep very meticulous records. So what I do and what I suggest you do is for every deposit you make to the bank, keep a copy of all the checks that made up that deposit along with the deposit slip and keep it in a separate file. If you do this and the IRS questions some of your bigger deposits, for example, if you have a $50,000 deposit and you borrowed a second on your home, you could just show them a copy of the check, show them the loan documents, and say it's not taxable. Similarly, if your Uncle Harry dies and his estate sends you $25,000 inheritance check, you show them the check and prove that it's not taxable. If your Aunt Ruth writes you a check for $10,000 as a gift and it's notated gift on the check and you have a copy, you just show the IRS, prove to them it's not taxable. Now if you're a business owner, the other way the IRS audits income is they look at your gross income and they look at your cost of goods sold, and they may do a normal markup. So they're going to look at what industry you're in, what your business is, and if there's normally a 20% markup, then those numbers should be commensurate. If you're a landlord, they're going to look at your leases to see that you're depositing the correct amount of income you should be getting if you have various units. In our next IRS Audit Part 2, we're going to talk about expenses and the record keeping necessary for you to prove those expenses.